All right, our third methodology is that of the amortization of an asset. I'm going to also sneak in the aforementioned bonus methodology in this, so you've made it long enough to see the bonus. So $3.9 million, and in this scenario, we're going to look at just amortizing that amount of money over a 30-year period of time. So we're just going to spend it down to zero and plan to do so. So I'll show you what that looks like. $3.9 million. We're going to take the same amount of gross cash flow every year for 30 years. We're going to pay the same tax rate because this is deferred. We're accounting for this all being deferred. So we're going to pay the same tax rate and pay $67,000 in taxes in the first year. Our net cash flow is going to be $157,000. And we're going to do the same thing year over year, right? $157,000. So right off the get-go, we're talking about $30,000, $40,000 more income than we were looking at in the total returns approach. However, there are still, there's some downsides as well, right? One being that we're planning at being out of money after 30 years, right? So we will definitely be out of money in 30 years. I'm going to throw in the bonus here and just say, what if instead of all this money being tax deferred, what if it was taxable? Let's just look at that. What if all this money, instead of being in a retirement account, was in, say, an after-tax investment account? And so we had a basis in it, meaning that we had $3.9 million. We're going to do the same thing. We're going to pull out a gross cash flow of $225,000. But if you'll notice now in this bonus example, our taxes are going down every year, right? The reason our taxes are going down every year is because this is an after-tax account. So a good portion of the money that we're taking for income has already been taxed. That means that each year, as we spend more and more of the principal of the $3.9 million, less and less of our income is actually taxed. So for the first time, we have added in a consideration to deal with the risk of rising taxes into the future, right? Because less and less of our money is even going to be taxed because of that basis. It's already been taxed. So as you can see, because of that, in this bonus example, now our income is also rising. We're paying less tax because a lot of it has already been taxed. So now our net cash flow in the first year is $178,000. So there's a $20,000 difference from just the amortization. And also it's rising every year to deal with inflation because our taxes are going down every year. So, some pretty big advantages to this amortization approach. Obviously, some big disadvantages as well, though, because at the end of 30 years, we are definitely out of money, right? So now we're going to move on to our last methodology, and that being the amortization of an asset.